Hello and welcome. We all know that the Union Budget for 2022 was presented on 1st February. Today, let's talk about the highlights of budget related to direct tax. Most anticipated topic of the time is taxation of virtual digital assets like cryptocurrencies, be it Bitcoin, Ethereum or any other cryptocurrency for that matter, or other digital assets like non-fungible tokens, in short NFTs. Of late, we have seen a lot happening over NFTs, and some of the celebrities too have auctioned their NFT collections and earned a huge sum too. Also, many of us would have bought and sold cryptocurrencies. So, proposal to tax digital assets has not come with any surprise. Income from sale of digital assets is proposed to be taxed at 30%. And this income would be taxed under the head capital gains. Capital gain would be sale consideration as reduced by the cost of acquisition. In other words, no deduction of expenses related to sale of digital assets would be allowed, unlike other capital assets. For example, if you sell a house property, then capital gain would be computed after reducing cost of acquisition and expenses related to transfer from the sale consideration. So this benefit of deduction of expense on sale of virtual digital assets would not be available. Then no set off of loss against any income. Suppose you sell the cryptocurrency that you have bought and you incur loss. Then this loss cannot be adjusted against any other income. Also, such losses cannot be carried forward to subsequent years, unlike other capital assets where you would be allowed to set off loss against any other income, or you would be allowed to carry forward such losses to subsequent years. This set off or carry forward of loss is not allowed when you sell virtual digital assets. Further, if you receive any digital asset as gift, then such gifts would be taxable in your hands subject to certain conditions. Next point to note is TDS provisions. So the payer, that is whoever is buying cryptocurrency and paying for it, is required to deduct TDS at 1% under section 194S. However, no TDS would be applicable in following situations. First, in case of individuals and HUFs having no business or professional income, if the consideration from sale of digital assets is less than 50,000 during the year. Next situation is for individuals and HUFs into business having a turnover or receipts up to 100 lakhs or into profession having turnover or receipts up to 50 lakhs in the preceding financial year, provided the sale consideration, that is value from sale of digital virtual assets, is less than 50,000 during a year. Then no TDS provision would apply. Then third situation would be in case of other payers like companies, firms, etc. if the sale consideration is less than 10,000 rupees for a year. Under these three situations, TDS provisions would not be applicable. Next key proposal is related to filing of updated income tax return. That is providing extended time period to update your income tax return. You can update return whether or not you have filed your income tax return earlier. Income tax return can be updated within the extended time period by making payment of additional tax. First, let's understand what's this extended time period. For that, we need to know what is the due date for filing of income tax return. For companies and others subject to audit, due date for filing income tax return would be 31st October. For assessees having international or specified domestic transactions, the due date would be 30th November, and for others it would be 31st July. In other words, usually for businesses subject to tax audit, the due date for filing income tax return would be 31st October. For assessees having related party transactions, be it international or specified domestic transaction, then due date would be 30th November. And for individuals like you and me, the due date would be 31st July. If you miss this deadline, you have an option to file belated return, and due date for that would be 31st December or before completion of assessment, whichever is earlier. If you have already filed the return within the due date and if you would like to revise the return, then also the last date would be 31st December or date of completion of assessment, whichever is earlier. If you have missed the deadline or if you would like to revise the return that we have already filed, then let's see how much time we have got. So for individuals, the due date is 31st July. So individuals have got 5 months, that is from 1st August to 31st December to file belated or revised return. For businesses subject to audit, the due date is 31st October. So they have got 2 months time, that is from 1st November to 31st December to file their belated or revised return. Then for related parties having international or specified domestic transaction, due date is 30th November. So they have got 1 month's time, that is the month of December, to file their belated return or to revise the return that has already been filed. This additional timeline to revise or to file belated return is certainly not enough. For business organizations, there is hardly any time left to revise the return. So to promote voluntary tax compliance, Budget has proposed to provide extended time period. This is over and above the time limit to file belated or revised return. But this extended time period comes with an additional cost. That is, we are required to pay additional tax over and above the tax that we pay at normal rates. Let's now see what additional tax are we required to pay if you would like to update our income tax return. If you update your return within 12 months from the end of the assessment year, then you are required to pay an additional tax of 25% of normal tax plus interest. If you update your return within 24 months from the end of the relevant assessment year, then rate of additional tax would be 50% of tax plus interest. To understand this better, let us consider a scenario. Let's say you are required to file your income tax return for financial year 2021. So assessment year would be 2021-22. For the sake of simplicity, let's assume due date of filing income tax return was 31st July 2021 and due date to file belated return was 31st December 2021. Now let's hypothetically say that you have filed your income tax return on 30th April 2022. So here the assessment year is 2021-22. So the end of the assessment year would be 31st March 2022. Number of months delayed would be 1 month, that is April 2022 in this case. So this return has been filed within 12 months from the end of the assessment year. So the rate of additional tax that would apply here is 25% of tax plus interest. Now let us consider another situation. Let's say the ITR would be filed by you on 30th April 2023. So end of assessment year would remain the same. Number of months delayed in this case would be 13 months, that is from April 2022 to April 2023. So this return has been filed after 12 months but before 24 months. So the rate of additional tax that would apply in this case would be 50% of tax plus interest. The rate that has been specified here is additional tax. In other words, you would be required to pay income tax at normal rates, surcharge if applicable, health and education cess, interest, late fee, etc. Apart from this, you would also be required to pay this additional tax. If you update your return without payment of tax, then such income tax return would be considered as defective return. In that case, you would be getting notice from income tax department asking you to pay dues, and if you don't pay your dues within the time limit specified in the notice, then the income tax return that you have filed would be considered as an invalid return. In other words, it would be considered as if you have not filed your income tax return. So when is this updated return feature useful? Let's say you have missed to file your income tax return and the original due date as well as due date to file belated return is over and you would like to file your income tax return. In that case, this is a useful feature. Then next scenario I can think of is, let's say you have filed your income tax return within the original due date and you later have noticed that there is some transaction missing or some correction is needed. Then you will be able to update your return using this update return feature. However, there are certain restrictions as to when you can't update your return. That is, you will not be able to update your return in some situations. Let's now see what are those. If your updated return is a return of loss, that is you have net loss, or if the updated return would result in reduction of tax liability, let's say you have filed your income tax return and paid certain tax. Now by updating the return, the liability is getting reduced, then in that case you will not be able to update return. Also, when you have refund or if updating the return would lead to increase in the refund already sanctioned, then you will not be able to update return. If search, also known as raid in common language, and survey has been initiated, then you will not be able to update the return. If you have already furnished updated return, then you will not be able to update the return for the same year. If any proceeding for assessment, reassessment, recomputation or revision is pending or completed under the Income Tax Act, then you will not be able to update the return for such years. If you have got any notice under Black Money Act or Prevention of Money Laundering Act or Prevention of Benami Property Transactions Act, etc., or if you have received any communication under these acts, then you will not be able to update your return. Let's now go through few other changes that have been proposed. First, for state government employees, deduction under section 80CCD, that is in respect of NPS contribution by the state government to the account of its employees, is proposed to be increased from 10% of salary to 14% of salary. Next, eligible startups. Eligible startups can avail deduction under section 80 IAC up to 100% of profits from business for 3 consecutive years if the startup has been incorporated between 1st April 2016 and 31st March 2022. This time limit has now been extended up to 31st March 2023, and this is a welcome change. Next, for cooperatives, alternate minimum tax under section 115JC, which was 18.5% earlier, has now been proposed to be reduced to 15%. Next point is a clarification related to surcharge and cess. Some businesses were claiming surcharge and cess on income tax as deduction towards business expenses. So the budget has clarified that the surcharge and cess paid on income tax cannot be claimed as business expenditure. What did we as individuals miss? There is no change in the tax slab or rate of tax. There is no increase in ATC or ATD deduction limit. No change in any other deductions like interest on home loan, etc. There was a huge expectation of reduction of net tax liability for individuals to boost consumption, but this did not find place in the budget. That's all I have for you in this video. Hope this was helpful. If you enjoyed this video, you may like and share the video. If you haven't already, subscribe to my channel for more videos related to income tax, GST, etc. Thank you for watching.